Right now, at this very moment, something catastrophic is unfolding in the global financial system, and the terrifying part? Almost nobody sees it coming. While you're watching news about politics, while you're scrolling through social media, while you're being told everything is under control, a single number in Japan just shattered 3 decades of financial stability. This isn't a prediction. This isn't a theory. This is happening right now, and it's going to affect every dollar you've saved, every investment you've made, and every plan you have for your financial future. Stay with me for the next few minutes, because what I'm about to explain will fundamentally change how you see money, markets, and the global economy. This isn't complicated financial jargon designed to confuse you. This is the raw, mechanical truth about how the system actually works. And once you understand it, you'll never trust the mainstream narrative again. Before we dive deeper, if you're serious about understanding what's really happening in the economy, if you want to see through the lies that mainstream media feeds you every single day, hit that subscribe button right now. This is Dark Economy, and this channel exists for one reason only: to give you the truth that powerful institutions don't want you to know. We break down complex financial events into clear, actionable intelligence that you can actually use. So subscribe, turn on notifications, and make sure you don't miss what's coming next, because the information I share here could be the difference between protecting your wealth and watching it evaporate. And do me a favor, hit that like button right now. Not later, right now. The algorithm needs to know this information matters, that people need to hear this. Every like pushes this video to more people who desperately need this warning. So pause for 2 seconds and click that like button. Trust me, you'll thank yourself later. Now, let's get into exactly what just happened and why it matters more than anything else you'll hear about this week. Japan's 30-year government bond yield just hit 3.5%. To most people, that sentence means absolutely nothing. It sounds boring, it sounds technical, it sounds like something only economists in dark suits should care about. But here's the truth. That single number represents the collapse of the entire free money system that has propped up global markets for more than 2 decades. That number is an earthquake, and the shockwaves are already tearing through every market on the planet. Let me explain this in a way that makes perfect sense. For over 20 years, Japan has been the world's cheapest piggy bank. The Bank of Japan kept interest rates at 0, sometimes even negative. This meant that massive hedge funds, investment banks, and international corporations could borrow trillions of yen for essentially free, 0 cost, no interest. Just free money sitting there waiting to be taken. So what did they do with all that free money? They didn't keep it in yen. They converted it to dollars, euros, and other currencies. Then they invested that borrowed money into everything. United States stocks, real estate across the globe, cryptocurrency, corporate bonds, emerging market debt, you name it. As long as they could earn more than 0%, which was almost guaranteed, they made pure profit. This strategy is called the carry trade, and it has been one of the most profitable, most reliable trades in financial history. But here's the catch. The entire trade only works under very specific conditions. Japanese interest rates have to stay low, the yen has to stay weak, and global markets have to stay stable enough that you can sell your investments when you need to. For 20 years, those conditions held perfectly. Hedge funds made fortunes, banks printed money, the whole system hummed along like a well-oiled machine. Until now. When Japan's yield suddenly spiked to 3.5%, everything breaks at once. Let me walk you through the mechanical chain reaction, step by step, so you understand exactly why this is so dangerous. First, borrowing costs explode overnight. If you borrowed yen when rates were 0, and now rates are 3.5%, your cost of holding that debt just became massively expensive. You're losing money on a trade that used to be free money. So what do? You panic. You need to close the position immediately. Second, the yen starts strengthening. Why? Because higher interest rates attract capital. Investors see they can now earn 3.5% safely in Japan, so they buy yen. When the yen strengthens, it means every yen you borrowed is now more expensive to pay back in dollar terms. So you're getting squeezed from both sides. Higher interest costs and a stronger currency. Your losses compound exponentially. Third, forced liquidation begins. Hedge funds can't sit around hoping things get better. They have risk limits, margin calls, and investors demanding explanations. So they start selling everything. US stocks, European bonds, real estate funds, crypto, gold, anything liquid enough to sell quickly. This isn't selling because the economy is bad. This is selling because the math no longer works. It's mechanical, automatic, and unstoppable. Fourth, the selling creates more selling. When major funds start dumping assets, prices fall. When prices fall, other funds hit their stop losses and risk limits. They start selling too. Algorithms detect the volatility and start selling automatically. Retail investors see their portfolios dropping and panic. The selling feeds on itself, accelerating faster and faster. This is how liquidity crises turn into crashes. Now here's where it gets even worse. Japan isn't just some isolated market. Japan is the third largest economy on Earth. Japanese institutions manage trillions of dollars in assets globally. And for decades, they've been forced to invest that money overseas because they couldn't earn anything at home. Japanese pension funds, insurance companies, and banks own over $1 trillion of United States Treasury bonds alone. They own massive chunks of European debt, corporate bonds, and real estate across the world. But now, at 3.5%, Japanese institutions can finally earn decent returns at home in yen with zero currency risk. Why would they keep their money in US bonds when they can get similar returns in Japan without worrying about exchange rates or foreign political risk? They wouldn't. So the money starts coming home. When Japanese institutions begin selling US treasuries, even in small amounts, it creates enormous pressure on the bond market. Bond prices fall, and when bond prices fall, yields rise. Rising treasury yields mean higher interest rates across the entire American economy. Mortgage rates go up, car loans get more expensive, corporate borrowing costs increase, credit conditions tighten everywhere. Suddenly, Japan raising their rates becomes an automatic interest rate hike for the United States, and the Federal Reserve doesn't get any say in the matter. This is not theoretical. We've already seen a preview of exactly this scenario. In August of 2024, the Bank of Japan raised rates by just 0.25%, just 25 basis points. The global reaction was immediate and violent. Japanese stocks crashed by over 10% in days. Cryptocurrency markets collapsed. US tech stocks sold off hard. The Nasdaq dropped sharply. Volatility spiked across every asset class, and that was just a tiny rate hike, a warning shot. What we're seeing now is far more serious. Rates aren't creeping up slowly anymore. They're breaking through major long-term resistance levels. Technical analysts call these breakout moments, and they tend to accelerate once the momentum starts. 3.5% isn't the end. It could easily go to 4%, 4.5%, or higher. And every tick higher tightens the noose around the carry trade. So why is this happening now? What changed? The answer lies in inflation and currency stability. For years, Japan struggled with deflation. Prices kept falling. The economy stagnated. The Bank of Japan tried everything to create inflation. Zero rates, negative rates, quantitative easing, yield curve control. Nothing worked. But recently, global inflation finally reached Japan. Import costs surged. Energy prices spiked. Food costs increased. The yen weakened so much that it started hurting Japanese citizens. The government had no choice but to raise rates to defend the currency and control inflation. But raising rates in a world built on free Japanese money is like pulling the foundation out from under a skyscraper. The whole structure starts to wobble. And that's exactly what we're seeing now. Let me be very clear about what happens next, because this follows a predictable pattern that we've seen repeatedly throughout financial history. When liquidity suddenly tightens, when easy money disappears, markets go through several distinct phases. Phase 1 is denial. Investors assume it's temporary. They buy the dip. They tell themselves central banks will step in and fix everything like they always do. Stocks bounce for a few days. People relax. This phase never lasts long. Phase 2 is recognition. More data comes in. More funds start reporting losses. More hedge funds blow up. The selling intensifies. Volatility spikes. News headlines shift from calm to concerned. This is where we are right now. Phase 3 is panic. Forced liquidation becomes widespread. Margin calls cascade through the system. Correlations go to 1, meaning everything falls together. Even safe haven assets like gold and silver get sold because funds need cash immediately to meet redemptions. This selling doesn't mean those assets are bad. It means the system is breaking. Phase 4 is intervention. Central banks realize the crisis is spiraling out of control. They hold emergency meetings. They announce massive stimulus programs. They cut rates. They restart quantitative easing. They inject liquidity directly into markets. This is where the money printing starts, and it never stops at just a little. It's always overwhelming, always more than expected. Phase 5 is the rally. Once the money printing is confirmed, once investors believe that central banks will do whatever it takes, capital floods into hard assets. Stocks rally, gold surges, silver explodes, real estate rebounds. Everything that got sold in the panic comes roaring back, often reaching new highs within months. We are currently between Phase 2 and Phase 3. The recognition is building. The pressure is mounting. The panic hasn't fully hit yet, but it's coming. And when it does, the intervention will be massive. Now let's talk about where the smart money goes during this transition. When bond markets are unstable, when currencies are weakening, when trust in financial institutions is cracking, investors look for safety. But what is actually safe anymore? Bonds aren't safe when yields are spiking and prices are falling. Cash isn't safe when central banks are preparing to print trillions. Stocks aren't safe when earnings don't matter and forced liquidation dominates. Real estate isn't safe when mortgage rates are surging and credit is tightening. So where do you go? You go to assets with no counterparty risk, assets that can't be printed. assets that have held value for thousands of years. You go to gold and silver. Let me focus on silver specifically, because this is where the opportunity is massive, and most people completely miss it. Silver is not just a precious metal. It's not just a store of value. Silver is the most undervalued, most manipulated, most overlooked asset in the entire financial system. And when this crisis fully unfolds, silver is going to shock everyone. Here's why. Silver has a unique dual role. It's both a monetary metal and an industrial commodity. This makes it incredibly powerful during the exact kind of crisis we're entering now. On the monetary side, silver has been money for over 5,000 years. It has no counterparty risk, meaning you don't need anyone's promise for it to have value. You don't need a bank to honor it. You don't need a government to back it. You don't need a corporation to guarantee it. Physical silver in your hand is final settlement. It's real wealth, not a claim on wealth. When confidence in the financial system starts cracking, when people realize that their wealth exists only as digital entries in fragile databases, they rush to physical assets. Gold gets attention first because it's traditional and well-known, but silver follows immediately. And it moves much more violently because the market is smaller and the available supply is incredibly tight. On the industrial side, silver is absolutely essential to modern technology. It's the best conductor of electricity. It's used in solar panels, electric vehicles, smartphones, computers, medical devices, and advanced electronics. Global industrial demand for silver is enormous and growing every single year. Unlike gold, which mostly sits in vaults, silver gets consumed in manufacturing and is rarely recovered. Now combine those two factors during a crisis. You have monetary fear driving investment demand for silver. Simultaneously, you have industrial demand that doesn't stop just because markets are panicking. Factories still need silver. Technology still needs silver. Green energy still needs silver. So supply gets squeezed from both directions at the same time. Add one more factor, Japan. Japan is one of the world's largest manufacturing economies. Japanese companies are leaders in electronics, automotive technology, robotics, and renewable energy. All of these industries require massive amounts of silver. When the yen strengthens, as it is now, Japanese purchasing power for raw materials increases dramatically. A stronger yen means Japanese companies can buy more silver for the same amount of money. So Japanese industrial demand for silver is about to surge at the exact moment that investment demand is also exploding. This creates what's called a supply squeeze. There isn't enough physical silver available to meet both demands at the same time. When that happens, prices don't rise slowly, they gap up violently. We've seen this pattern before, and it's about to happen again. Look at history. People who bought during the panic made life-changing returns. In 2020, the same pattern repeated. When COVID hit, markets crashed. Silver dropped from $18 to $12 in a matter of weeks. Fear dominated everything. But the moment the Federal Reserve announced unlimited quantitative easing, silver reversed hard. Within 4 months, it doubled to over $29. Again, the people who understood the pattern and bought during the fear made incredible profits. The setup right now is even more extreme than both of those previous crises. The debt levels are higher, the money printing will be larger, the supply constraints in silver are tighter, and most importantly, almost nobody sees it coming this time. When the masses finally wake up to what's happening, when they start searching for ways to protect their wealth, the rush into silver will be unlike anything we've seen before. But here's the critical point. You have to position yourself before the panic. Once the mainstream media starts talking about it, once your neighbors and coworkers are discussing silver, it's already too late to get the best prices. The big moves happen when nobody's paying attention, when fear is still building, when most people think everything will be fine. Right now, we're in that window. Most people are distracted. Most people trust that central banks have everything under control. Most people believe stocks will keep going up forever. They're not watching Japan. They're not watching bond yields. They're not connecting the dots. That's your advantage. If you're still watching right now, I need you to do something. Comment the word silver below this video. Let me know you're paying attention. Let me know you understand what's happening. The engagement helps push this message to more people. And honestly, I want to know who in this community is actually preparing. So comment silver right now. Also, share this video. Send it to someone who still thinks bonds are a safe investment. Send it to someone who trusts their financial advisor blindly. Send it to someone who needs to hear this truth before it's too late. Information like this isn't shared on CNBC. Bloomberg won't explain it this clearly. Your bank certainly won't warn you. So it's up to us to spread the word. Now let's talk about the Federal Reserve and why they are completely trapped by what's happening in Japan. The Fed has been trying to fight inflation by raising interest rates. Higher rates slow down borrowing, reduce spending, and theoretically bring inflation under control. But there's a massive problem. The United States government is now carrying over $34 trillion in debt. At higher interest rates, the interest payments on that debt become astronomical. Do the math. If the average interest rate on U.S. debt goes to 5%, that's $1.7 trillion per year just in interest payments. That's more than the entire defense budget. That's more than Social Security. The government literally cannot afford it without printing more money, which causes more inflation, which requires higher rates, which increases the debt payments even more. It's a doom loop with no escape. Now add Japan into this equation. If Japanese institutions start selling U.S. treasuries, yields spike even higher. The Fed can either allow that to happen, which bankrupts the government, or they can intervene and buy the bonds themselves. Buying bonds means printing money. Printing money means inflation. Inflation means the dollar loses value. When the dollar loses value, foreign investors sell even more treasuries. The doom loop accelerates. This is called yield curve control, and Japan has been doing it for years. It means the central bank sets a maximum yield on government bonds and promises to buy unlimited quantities to keep yields below that level. It's a direct declaration that they will print infinite money to control interest rates. The moment the market believes the Fed will do this, confidence in the dollar collapses. Investors flee anything denominated in dollars. They rush to hard assets that can't be printed. The Fed is trapped between two impossible choices. Let rates rise and collapse the government, or print money and collapse the currency. There is no third option. History shows that central banks always choose to print. They will sacrifice the currency to save the system every single time. It's not even a debate. It's mechanical. And when that printing starts, when the Fed announces their version of yield curve control, when they admit they have no choice but to buy unlimited bonds, that's when silver goes parabolic. That's when the real wealth transfer begins. The people holding physical assets will watch their purchasing power multiply. The people holding cash and bonds will watch their wealth evaporate. You need to understand something crucial about timing. The best returns don't come from buying at the absolute bottom. The best returns come from buying before the masses realize what's happening. By the time silver is on the front page of every financial website, by the time your family is asking you about it, the easy gains are already gone. This is your moment. This is the window. Japan's yield breaking above 3.5% is the signal. It's the alarm bell ringing. It's the warning that most people will ignore until it's too late. Let me address the obvious question. What if I'm wrong? What if Japan's yields stabilize? What if central banks manage to control this? What if everything goes back to normal? Here's my answer. Even if this specific crisis gets delayed, the underlying conditions haven't changed. The debt is still there. The money printing is still there. The fragility is still there. Silver remains undervalued regardless. You're not making a bet that the system collapses tomorrow. You are making a rational decision that holding real assets is smarter than holding paper promises in an era of infinite money printing. But I don't think I'm wrong. I think the mechanics are already in motion. The forced liquidations have started. The bond yields are breaking. The currency pressures are building. This isn't speculation. This is observation. One more thing I need to mention. When this crisis intensifies, you're going to see wild volatility. Silver might drop first before it rallies. Gold might sell off temporarily. Even physical assets get hit in the initial panic because funds need cash for margin calls. Do not let that shake you. Do not panic sell when you see prices drop. That drop is the opportunity. That's when you add to your position if you have the cash available. The people who make the biggest gains are the ones who stay calm when everyone else is losing their minds. This is the pattern. This is how it works. Fear comes first. Selling comes first. Then the money printing is announced. Then the rally begins. If you understand the sequence, you profit. If you panic during the fear, you lose. I want to be very direct with you. This video isn't entertainment. This isn't clickbait designed to get views and move on. This is a genuine warning based on mechanical analysis of what's happening in global markets right now. I'm not trying to scare you for no reason. I'm trying to prepare you for what's coming so you can protect yourself and potentially profit. The mainstream financial media won't tell you this. They can't. Their job is to keep you calm, keep you invested, keep you believing everything is fine. They serve the institutions, not you. They need you to stay in stocks, stay in bonds, keep your money in the system. If everyone pulled their money out and bought physical assets, the system would collapse immediately. So they downplay risks. They mock people who prepare. They call gold and silver old-fashioned. They tell you to trust the experts and stay invested. But the experts are trapped in the same system. They can't see outside of it. They're trained to believe central banks are all powerful. They're trained to trust that markets always recover. They're trained to think long-term while ignoring short-term risks. And when the crisis hits, they'll be just as shocked as everyone else. You don't have to follow their advice. You can think for yourself. You can look at the data. You can see what's happening in Japan. You can understand the mechanics. And you can position yourself accordingly. Let me give you a final thought. Wealth isn't destroyed during crises. It's transferred. The money doesn't disappear. It moves from people who don't understand what's happening to people who do. From people holding paper assets to people holding real assets. From people who panic to people who prepare. This crisis, when it fully unfolds, will create enormous winners and enormous losers. Which side you end up on depends entirely on the decisions you make right now. So here's what I want you to do after watching this video. First, educate yourself further. Don't just take my word for it. Research the carry trade. Look at Japan's bond yields. Study what happened in 2008 and 2020. Understand the pattern. Knowledge is your best protection. Second, evaluate your current financial position. How much of your wealth is in paper assets? How much is in physical assets? How exposed are you if bond markets break? If the dollar weakens? If stocks crash? Be honest with yourself about your risk. Third, consider making changes. I can't give you financial advice, but I can tell you what makes sense to me. Holding some physical silver seems like a very rational decision in this environment. It's insurance against currency collapse. It's leverage on money printing. It's exposure to industrial demand. And it's massively undervalued relative to gold and relative to history. Fourth, stay informed. Subscribe to this channel if you haven't already. Turn on notifications. I'll keep breaking down what's happening as this situation develops. The mainstream media won't connect these dots for you. You need sources that tell you the truth. And finally, prepare mentally for volatility. The next few months could be wild. Markets could swing violently. Headlines could be terrifying. Don't let that shake your long-term understanding. Stay focused on the fundamentals. Stay focused on the mechanics. Trust the pattern. This is dark economy. This is where you come for truth about money, power, and the hidden forces shaping your financial future. I don't sugarcoat things. I don't tell you what you want to hear. I tell you what you need to know. And right now, you need to know that Japan's bond market just sent a signal that cannot be ignored. 3.5% on the 30-year yield. That's the number. That's the line in the sand. Everything that happens next flows from that single number. The carry trade unwinds, liquidity drains, central banks panic, money printing accelerates, and silver explodes. But let me take this even further because there's a critical layer most people miss when analyzing these macro events. The derivative markets, sitting on top of all this, are absolutely massive and completely unstable. We're talking about interest rate swaps, currency futures, and leveraged positions that dwarf the actual underlying markets by factors of 10 or 20 times. When interest rates move violently like they're doing now in Japan, these derivative positions start hemorrhaging money at an alarming rate. Banks and financial institutions use these derivatives to hedge their positions. But here's the dirty secret. They're not actually hedging, they're speculating. They're taking massive leveraged bets that rates will stay within a certain range. When rates break out of that range suddenly, like we're seeing now, the losses compound exponentially. A 1% move in rates can create losses of 10, 20, or even 50% on leveraged derivative positions. And we're not talking about small amounts of money here. We're talking trillions of dollars in notional exposure. This is why central banks panic so quickly during these events. It's not just about the bond market or the stock market. It's about the interconnected web of derivatives that ties every major financial institution together. When one bank starts taking heavy losses on interest rate derivatives, it creates counterparty risk for every other bank it's connected to. Suddenly, banks stop trusting each other. Credit markets freeze, lending stops. And we're right back to a 2008-style financial crisis, except this time, the debt levels are far higher, and the central banks have far less ammunition to fight it. The Federal Reserve and other central banks learned from 2008 that they cannot allow the banking system to seize up. They will do absolutely anything to prevent that from happening, and anything means unlimited money printing. It means backstopping losses, it means buying assets that nobody else wants, it means keeping zombie banks alive even when they should fail. The moral hazard is enormous, but they have no choice. The alternative is complete systemic collapse, and no central banker wants that on their resume. So when you connect all these dots, the conclusion becomes crystal clear. Japan's rate, spike forces derivative losses. Derivative losses threaten banks. Threatened banks force central bank intervention. Central bank intervention means massive money printing. And massive money printing means hard assets like silver become the only rational place to store wealth. Let me also address the supply side of the silver equation, because this makes the coming price explosion even more inevitable. Silver mining is incredibly difficult and expensive. Unlike gold, which is often found in large, concentrated deposits, silver is usually found in small quantities, mixed with other metals. This means silver is often a byproduct of mining copper, zinc, or lead. When those primary metals become unprofitable to mine, silver production drops as well, even if silver prices are rising. Global silver mine production has been essentially flat for years despite rising demand. New mines take 7 to 10 years to develop from discovery to production. There's no way to quickly increase supply when demand surges. And right now, above-ground inventories of investment-grade silver are at multi-decade lows. The COMEX warehouses that store silver for futures contracts are being drained. Silver eagles and other coins are selling out regularly. Premiums on physical silver over spot prices are elevated, which tells you there's a shortage of actual metal available for immediate delivery. And when industrial demand from Japan increases due to the stronger yen, when investment demand increases due to monetary fear, and when supply cannot respond quickly, you get a price shock. Not a gradual rise, but a vertical move that catches everyone off guard. This is basic supply and demand economics playing out in real time. I also want you to understand the psychological component of what's coming. Right now, most investors are still complacent. They've been conditioned over the past 15 years to believe that every dip gets bought, that central banks always save the day, that stocks only go up in the long run. This complacency is dangerous because it prevents people from taking defensive action until it's too late. When the real panic hits, when margin calls cascade through the system, when funds start blowing up and making headlines, that's when psychology shifts violently. Suddenly, everyone wants safety at the same time. Everyone rushes for the exits together. The selling becomes indiscriminate and brutal. This is when you'll see Bitcoin drop 30% in a day, when you'll see tech stocks crater, when you'll see real estate funds suspend redemptions. The fear will be palpable and overwhelming. But here's what separates the prepared from the victims. The prepared understand this is temporary. They know the pattern. They know central banks will intervene. They know money printing is coming. So they either hold steady or they buy more during the panic. The victims, on the other hand, sell everything at the worst possible moment, lock in their losses, and then watch helplessly as markets recover without them. Your mindset during the next few months will determine your financial outcome for the next decade. I cannot stress this enough. If you understand what's happening, if you position yourself correctly, if you stay calm during the chaos, you will come out of this crisis significantly wealthier. If you panic, if you sell at the bottom, if you trust the wrong advisors, you'll be devastated. This is also why I keep emphasizing physical silver specifically. During a liquidity crisis, paper assets become suspect. ETFs can halt redemptions. Futures contracts can be cash settled instead of delivering metal. Allocated storage can suddenly become unallocated. But physical silver in your possession cannot be frozen, cannot be rehypothecated, cannot be claimed by anyone else. It's yours, completely and finally. The wealthy have understood this for centuries. When systems become unstable, you convert paper wealth into tangible assets. Land, precious metals, art, anything that exists in physical form and cannot be printed or inflated away. This isn't paranoia. It's prudent wealth preservation that has worked for thousands of years across every civilization and every currency collapse. Now, I know some of you are thinking this sounds extreme. You're thinking maybe I'm exaggerating, maybe things won't get that bad, maybe the system is more stable than I'm suggesting. I understand that reaction. It's natural to want to believe everything will be okay. But I'm asking you to look at the actual data, not your hopes or assumptions. Japan's 30-year yield at 3.5% is a fact. The trillions in carry trade positions are a fact. The derivative exposure is a fact. The government debt levels are a fact. The limited tools central banks have left are a fact. These aren't opinions or predictions. These are observable realities happening right now. And the mechanical consequences of these realities are unavoidable. You don't have to believe me. You can watch it unfold over the coming weeks and months. You can wait for confirmation. But waiting means you'll be buying silver at much higher prices if you can even find it available. The smart money doesn't wait for confirmation. The smart money acts on understanding before the crowd catches on. So make your decision. Continue trusting a system that's showing obvious cracks, or take steps to protect yourself with assets that have survived every crisis in human history. The choice is yours, but the clock is ticking. Comment silver below. Like this video. Share it with everyone who needs to hear this, and get ready. The repricing event has already begun. The system is adjusting whether you're prepared or not. Your job is to make sure you're on the right side of this transfer of wealth. Thanks for watching. Stay sharp, stay informed, and I'll see you in the next video where we'll dive even deeper into what's coming.